Welcome back to Investing in Poland series. Żabka IPO'd in October 2024 and currently they are the 11th biggest public company on the Warsaw Stock Exchange. They operate in the retail segment and years ago they started the business as a simple corner store. What makes this business the most interesting is that Żabka managed to sell not just the groceries, but the entire lifestyle, matching today's consumer needs. But now, they call themselves a tech-powered convenience ecosystem, and they support this statement with an app where, besides the standard royalty program, you can order food to your home, book a taxi, or even buy an insurance. And of course, we can't forget about the hot dog making robots tested in their fully autonomous store concepts. In this video, we'll go through the key business highlights, discuss the biggest opportunities and risks, and finally, we'll run some valuation exercises. Let's get into it and start with the key business highlights. Just as a reminder, this is not a recommendation of any kind. I hold Żabka shares and the video represents only my private opinions. Let's get into it. If you haven't heard about Żabka yet and you don't know how to compare this to more broadly known businesses, I have good news. Żabka is very similar to 7-Eleven, and while there are always differences and nuances, the concept is similar. I won't focus on the comparison, but instead I'll try to share as much as possible about Żabka itself. By the way, recently Żabka stock rallied after 7&I Holdings, which is planning more European expansion, announced talks with Żabka about the possible investment, but this discussion already dropped, so has the price. Funny enough, after a few days the stock rallied again after the earnings, which were quite good. July 25 was the official date when 7&I Holdings stepped away from the discussions. And that's not enough because the Alimentation Couche-Tard announced a complete acquisition deal for 32 zlotys a share, so nearly 32 is the price by the end of July 31st market close. I managed to buy Żabka near the bottom, so I'll make a nice return in 4 months, but overall, I'm extremely unhappy with this development because I was hoping for the very long investment. But on the bright side, I hope that this video with the local insights will be very useful for ATD shareholders. Okay, let's visit one of the Żabkas. In the Dino company preview, you could watch the recording where I was walking around the store, but this time we'll do it with the pictures. I appreciate the feedback on what works better. At the entrance, we are seeing some small shopping baskets, and even though they are there, rarely anybody uses them because this store is focused around fast shopping and fast meals. The stores are of course standardized, so you'll find pretty much the same products in every store. And here we're seeing a lot of food related to quick meal services, which is crucial and fast growing part of their business. In the next fridge, we're seeing even more quick meals, but also a standard food items. The trend for these fast meals is definitely a tailwind for Żabka, and over the last years they were increasing the offer in this segment. I couldn't capture on the picture inside the store as they are preparing this food on the go, but the menu for hot dogs, pizzas, burgers and other types of fast food is growing. And it seems to be growing in consumption as well, because I'm seeing more and more people using this as the daily routine. I'm providing the link in the description so you can check the menu directly. And this chart from the investor presentation shows how much Żabka expanded its offering from simply a coffee plus hot dogs up to a salad, sandwiches, pizzas, burgers, and so on. It's also important to note that the QMS traffic constantly grows. Let's go back to the store and look at the other shelves. Here we have cold drinks and beers. And that's an additional row in the store with more soft drinks and snacks. And on the right, there is a variety of the daily utility products for bathroom and for the home. Also some pet food. So technically, despite these stores being often very small, you could buy almost everything here and avoid shopping in the supermarket if you really want to. One more pictures with waters, more snacks, fresh fruits and vegetables. And the wine shelf. Finally, a cash register with the left angle on the liquor and cigarettes wall, and on the right one, this is a quick meal services sector called Żabka Cafe 2.0 with an oven and other equipment necessary to make warm fast meals. In addition, here are pictures from the LinkedIn profile of Vice President and CEO of Żabka Polska unit, and they reflect how the cafe concept usually looks like. Note that in some Żabkas, they are trying to make it even more cafe-like by adding tables and so on, but in general, I'm seeing that people take coffee and food for the go. Going back to 7-Eleven, in the US stores as a main quick food, I saw pizzas by the slice, where in Żabka the main offer and popularity is with hot dogs, which they have started with, and you order the whole pizzas, not the slices. I hope now you have a better sense of the dramatic differences between 7-Eleven and Żabka. This layout shows the strategic allocations where things for here and now are located at the front and things which you will probably consume later are, let's say, a few seconds further away. And this is definitely a key because the whole concept is organized around speed. Of course, I saw divergence from this concept because sometimes Żabkas are super small, so they kind of have to rearrange things. But then it's even faster to do the shopping and just go in and out very quickly. I mentioned before that they sell lifestyle. And they keep experimenting with the new concepts, like one is doing an ad hoc Żabkas located at concerts or other events, especially during the summer. And second is Żabka Nano, which is a fully automated store concept where you enter using the Żabka app and making the whole shopping on your own, and there are no employees inside. Also, it's open 24/7. Normally, the nano concept doesn't seem to be very successful, and some nanos I've visited have way more limited offering. But in my opinion, the main goal with this concept right now is to test various automation solutions which can be applied then to the vending machines or the franchise stores, where, as we'll see later, doing more automation may be a key to good margins. In terms of the coverage in Poland, they are truly everywhere right now, with high density in large cities. And definitely investors should build an opinion on how much more they can grow and think about the cannibalization process. In terms of growth, they continue to aggressively expand where possible, including small cities and villages recently. This very aggressive opening tactics is visible especially in the bigger cities. Here we're looking at the downtown of Wrocław, which is the third largest city in Poland. And it's literally at the every corner. In Warsaw, Just take a look at this map. If you zoom out the map a bit, you'll see that there might be 5 to even 50 Żabkas around a few blocks. Also, Poland is still aggressively developing the real estate, and they seem to be monitoring a newly developed neighborhoods closely, because every time a few or even a single multi-family building gets constructed, Żabka is already there at the ground floor, sometimes even before people move in. Also, sometimes they make it a bit too many and too dense in the area, which is bad for per Żabka revenue, but nearly impossible to open any other grocery store nearby. Looking historically, they've started just as a simple corner store, and 15 years ago this was mostly a place where you could buy very basic groceries, but probably you were visiting the store because your friends are coming soon for the game or evening party, and you figured you don't have enough of drinks and snacks. Over those years, they made quite a journey with making a way better selection, including some quality items, but definitely the big deal is with cafe and quick meal services. In parallel to that, they acquire MatchFit, which helps expand their menu, and it's a direct-to-consumer meal provider. I'm never bullish about such dietary concepts, and I don't think MatchFit will be highly impactful on their top-line revenue, but synergy is clearly there. At the same time, they are working more on the food delivery aspects and have a Delio supermarket. Also, they are working on fast delivery solution called Żabka Już, which is a Polish wordplay for Żabka Now. As for now, I don't see that this will be a huge growth engine, but it's good to see that they don't stop in trying new concepts, and these look definitely very synergic. Also, don't forget that they do have a huge network of stores located almost everywhere, which they can leverage for various purposes. And with all of that, we have an international expansion, which is one of the key initiatives I'm observing. Besides Romania, they are more openly talking about other countries, and I saw some speculations about Bulgaria. The key assumption to make is that Romania will do well over time, but at the moment I don't have expectations about other countries. But I do look forward for expanding into more countries. It's also interesting to see what the 7 and I holdings will do, because after dropping their investment in Żabka, they may clash in some countries. And this may create more challenging dynamics than in Poland, because in Poland they were expanding on the strong country development tailwind, combined with the fact that they don't have very strong player which could compete with their aggressive tactics. Oh, and let's not forget about Żabka's own ad platform and Easy Drop, which is an attempt to further expand their business related to parcel delivery. I'm more bullish on ads from these two. However, Żabka used to be a choice for parcel delivery for me before InPost built automated parcels machines everywhere and other companies like Allegro jumped on this trend. As a side remark, a lot of people in Poland, including myself, prefer the automated parcel machines because they are everywhere and you don't have to be at home when the courier rings at your door. Basically, you want the parcel wait for you and you don't want to be waiting for the parcel. Too bad InPost as an investment is not possible anymore, as for now it's in the process of taking the company out of the Amsterdam Stock Exchange. Going back to Żabka, we can't forget about the efficient logistics, and they are of course working on that, and opening modern and highly automated logistics centers. This video from Spożywcza TV channel shows the one opened around 3 years ago northeast of Warsaw, and now they have opened a newer one south of Warsaw. Now let's talk about the franchise model, which is on one hand the source of their success, margins and scalability, but at the same time I believe it is crucial that investors make own opinion on this in order to properly account for risks. Look at the voluntary churn rate. To me, that is actually a source of serious concern, which we will analyze in a minute, but it's also important to think about it as margin dynamics between franchisee and the company itself. On one hand, you need to make sure that the franchisee margin is at least at manageable level, and at the same time, the franchisee margin competes with the company EBITDA. I believe that an investor must spend some time thinking about that and make an opinion, as this is the most fundamental aspect of this business. As an example, here's the article, link of course is in the description, which provides quite realistic estimates. They claim 6,000 to 8,000 net income per store as something typical. For comparison, the minimum wage in Poland is around 3,800 net, and you get around that, for example, as a cashier in Dino. But of course, in case of running Żabka, you are running the business, handling the risks and manage employees. And you are responsible for the inventory losses or outdated inventory. Of course, there are high income cases, but still this churn rate makes me think about the worst cases than the typical income. And Reddit is quite rich in negative stories about that. There's an important aspect of a churn rate, and if you translate this into an actual number of franchisees, we can see an interesting dynamics and something strange in the numbers. So basically, they say they have recruited 2,600 of new franchisees with 1,200 of new stores opened. Note that a single franchisee on average handles 1.14 of Żabka. First of all, the nearly 800 franchisees who churned is definitely hard to ignore. But then the most important things come with the remaining 800. We don't have a clear timing data here, and we can account for forward recruiting, and there could be some other variables, but still, how to explain the additional 800? This should be something to closely monitor because it relates to the foundational business model, and the margins would collapse if they couldn't sustain this franchisee model as it is right now. Here you can see the highlights from the March 20th conference call. I strongly encourage you to either play the whole conference on QuarterUp or Investors page, or read the whole transcript because it's the key for healthy thinking about the company. The key highlight here is that if you consider those statements, the bottom line will be that the main source of margin is the QMS, and as I said before, we need a margin for both Żabka and the franchisee so this model remains successful. Also, what I'm seeing in the various Reddit discussions, the margin on QMS for franchise may be at 20%, which saves the whole thing because other margins could be like 5 or 10%. And that would not allow the franchisee to survive even in the very attractive and high traffic area. Also, from those comments, it's clear that the management is aware that a higher employee cost is a growing problem to the franchisee. However, going back to the previous chart, I'd say that this stays in the eternal company franchise margin conflict, and in my opinion, this is the main problem for the business. Because yes, Żabka Group creates value for the end customers and captures it, but in reality, there is a real in-between customer, which is a franchisee, and a very happy franchisee means bad margins for Żabka, and very unhappy franchisee with bad margin means the lack of the bridge between the Żabka and the customer because there will be no franchisees. I'm so passionate about the franchise because in the annual report for 2025, on the page 189, you'll encounter an exciting fact with the revenue breakdown, and it clearly says nearly 94% of the revenue comes from the franchise. At least I would assume it's probably exciting to people reading annual company reports. By the way, the wholesale is growing a lot, and this category contains new growth engine, which is a digital business and Romania. Now, let's talk very briefly on the competition. In simple terms, I don't think there is one-to-one competing concept, but the whole Eurocash group with the variety of stores compete. You can say that even Dino or Lidl somewhat competes. Also, the gas stations in Poland have a broad quick meal services offering and may offer quick shopping experience, but there is no one-to-one model. On the picture, we'll see Gamma Store, which is part of the Eurocash group, and yes, you can do the grocery shopping, but the food offering is completely different. We're seeing a broad offer of the homemade Polish food, which people line up for every day because it allows them to buy a good, fresh, ready-made lunch or dinner, and people who buy this are quite different type of customer than the fast food one. The valuation with the takeover on the table doesn't matter as much now, but I'll share the exercises I was making in the past. These days, running DCFs is definitely easy because you can use multiple tools or AI models to do that for you, but picking the right parameters into the model is something that nobody will do for you. Also, what I'm constantly seeing is that people generally tend to extrapolate last few quarters to the future and often also use low expected return values. And why this may be useful, this may be a thinking trap. Think about this that way, like let's say the growth rate usually was a 15% and you think you're doing a conservative estimate by assuming a growth rate of 12%. What if it's 5 or 4%? Like, you will be completely wrecked with the investment. So keep this in mind and make sure that if you're investing in the individual stocks, you have truly independent thinking. Here I'm going to share concepts for the educational reasons to help you think about it. And keep in mind that my goal in this video is to provide a company and a business preview, and hopefully it helps you think about the businesses in Poland. Just to set some base, let's take a look at the historical multiples of the enterprise value to EBITDA for somewhat similar companies like 7-Eleven, Alimentation Couche-Tard, Dino Polska, and Eurocash. Of course, we're seeing that Dino tended to have way higher multiples, but they were growing like crazy, had very efficient business model, which I shared in the other video, but also they had no real competition in the rural areas when they decided to focus on. So they were kind of special, and honestly, I don't believe Żabka can get to those multiples. On the opposite front, we have the Eurocash, which is struggling, and the multiple of 5 sets the safe base, which Żabka shouldn't ever hit unless they get into a trouble. At least that was my thinking half a year ago. Personally, I don't think betting on any multiple expansion is a good idea, and I think looking at multiples between 7 to 10 is very fair. Also, the multiple assumption route is not something I would ever prefer, but if you like that, definitely it's better to assume something conservative and have a surprise in the future rather than a disappointment. Also, if I don't see an opportunity based on the conservative assumption, I tend to skip the investment because what's the point in picking the stock if it trades at perfect average? Finally, some of my Excel calculations, and I always recommend to do modelings on your own, even if it's very simple. Entering the values manually helps me think about the actual money and margins rather than just blindly assuming some percentage growth rates and multiples. This becomes sometimes very artificial. And sometimes it's useful to think about the multiples, but it can get very counterproductive and drive you away from the business and turn the valuation into a number guessing game. Also, own modeling is a good checkpoint because for some companies I had no clear idea and found impossible to build even a very simple model, and this helped me to skip the company which honestly I didn't understood. In this model, I used the expected return of 10% and did a simple net income per share calculation. And this is the version with 12% expected return, and it looked really attractive in the past, basically around 4 months ago. And finally, experiment with the operating income. Of course, you can put any numbers and it's quite sensitive, but it's important to really think about it and decide what assumption we feel confident and whether such scenario provides a real opportunity or at best will give you only the market return, which probably should drive you towards skipping the investment. Let's wrap up for today. Let's assume the acquisition gets finalized as is, nothing crazy happens, and the remaining 43% of investors don't fight on the acquisition price in any way. In the very simple terms, Żabka was generating about 7 billion USD for 2025 and ATD's revenue was over 70 billion. So without going into the exact numbers, this gives you a 1 to 10 ratio, so still quite significant. And this is perhaps interesting to track. I'm not sure how the Żabka will be reported and tracked under the ATD's report, but if you're interested in the retail space, I would still track the following numbers if possible. Like-for-like growth, QMS development for Poland, Romania, and the new countries, international expansion and other countries. How well and how fast is it going? Because we had a long development history in Poland while Żabka was private. So how this will work elsewhere? Will consumers buy the concept and lifestyle that Żabka is proposing and how much time it's going to take? Potential clash between ATD and 7 and 11 or other competitors in a new countries. I'm curious if anything meaningful will play out here. So also Poland margins versus international margins, can they be quite different? We'll see. Also the franchise churn rate is something that I was very interested about. I hope you learned something about investing in Poland. See you in another video.